Hello, everyone. So my name is Jeff. I'm from Edunetwork. So today we'll be having a session on our IFRS 16 leases on how to identify a lease, right? When there's a contract between two parties, right? So we're going to cover the theory on that part. Okay, so let's get into it. Okay, so we've got to understand how a lease is brought about, because these are the questions that you'll be frequently asked, and they are very attainable when you understand what is going on. Okay, so we understand that most students shy away from theory questions because many people are used to the calculations, but that's where you earn a lot of marks if you really understand your theory. Okay, so we need to understand that a lease is a contract, right? It's like your usual document, right, between two people, right? So it reads as follows. This is a contract between two parties that creates enforceable rights and obligation. So from the creation of this contract, one will attain rights, the other will have an obligation, right? As a result of a lease, okay? So, and then it says that it conveys the right to use an asset for a period of time in exchange, right, for a consideration. Obviously, when you are using someone else's asset, that asset is not yours. So you will get the right. So it's a right to use someone else's asset. Okay. So normally in your questions, you will be asked on machines, vehicles, buildings, equipment. All right. Sometimes they like to ask on the floor space. But if you want to get more on that, you can attend the classes, okay, which we conduct. So we have two parties that are involved. So we use these two terms. We use lessor, all right, which is the party that provides, right, the asset, right? Okay, so that will be the owner of the asset. And then you are going to get the lessee, which is the party receiving the right to use. So you are given an asset, all right, to say, use my asset for a period of time. And in turn, I'll get a consideration for borrowing or for lending you the asset, okay, for the specified time, depending what the contract states. So you need to familiarize yourself with these two terms, lessor, lessee, lessor, lessee. All right. And then as we go, right, I'll be posting more videos. You will then get the disclosure. How do you disclose the same information in a contract in the books of the lessor, the same information in the books of the lessee? So they have different disclosure requirement in terms of IFRS 16. So we'll get into that as the weeks go by. All right. So, and then within a lease, there is what they call a finance lease. There is what they call an operating lease, but we will not dwell on that today. We'll do that as the weeks go by, right? So watch out for the coming classes on those two, right? Which is predominantly theory as well on those two, right? But our focus today will be on the identification of a lease. How do you identify a lease? All right, so we're going to do a question, and I'm going to explain via that question on how you approach such a theory question, so that you get the maximum marks. Very easy and straightforward. So remember, these topics that you're asked on your accounting, these are real life situations. Companies sometimes don't want to own assets, but they prefer to lease because the risk is less, because it's not your asset, right? Or sometimes when you're buying something, you don't have the immediate cash. So when you enter through a lease, it is better off. Okay, it's a better option. So there are so many reasons why people go into a lease. But what is important for now is, how do you identify a lease? For instance, let's say you are now the financial director, or you're now an accountant, right? And the company has just got into a contract. So you need to determine if that contract is a lease or if it is something else. All right. Does it meet the requirements of your IFRS 16 or not? All right. So there are three things that you should take note of when you're answering a question on identifying a lease. You are going to get number one. You're going to get number one, the right to control the use of the identified asset. Okay. The asset identified. So do you have the right to control it? Like, okay, to control it. So what does that mean? So within, all right, within this point, there are two things that you need to be aware of. That the right to obtain the economic benefits through the use of the asset. Number two, a right to direct the use of the asset. So these things are always addressing right to control. So whenever you are asked on a lease question, if a contract is a lease, when you come to point number one, you need to talk about these two. Very important, okay? Because that's where most of the marks will lie, right? The other two are straightforward, right? For a period of time, right? So obviously you know that this lease is for a year, this lease is for 2 months, this lease is for 4 months, or for 4 years, 6 years, whatever, right? And then obviously there's a consideration, okay, that should be stated, that should be straightforward for everyone, okay? It's a payment that you're making over how many years, and how many payments are you doing per year. It can be monthly, it can be quarterly, it can be twice a year, which is biannually. It will depend on the question, but that should be straightforward for us on the consideration. But the difficult part, or the challenging part, is this one, of which I'm going to try and explain to you guys. All right. So I'm going to share the following notes to expand on point one only. These two, as I've said, these two are straightforward, but this one will need more clarity. All right. Okay, so they are the notes. So it says, okay, a contract is a lease if, right? One, I said it conveys the right to control the use of the identified asset. So the asset can be explicitly stated in the contract, or implicitly, right? It can be implicitly. So it sometimes is not clear, right? And then we are saying that which includes both of the following, right? The right to obtain substantially all the economic benefits from the use of the identified asset. So we are talking about the primary output. So when we talk about economic benefits, right, we are talking about what is produced from the right of using that asset. Okay, so if you can obtain substantially, which is majority, right, of what is produced, the output and any byproducts, we are saying you have the right to obtain substantially the economic benefits. All right. And then we said number two, we spoke about the right to direct the use of the identified asset throughout the period of use, how and what purpose it will be used for. So right to direct how it is used. So the first one was economic benefit. Second one is direction of use. So how do you identify direction of use in a given scenario, right? You will pick up things like, so I said here, assessment of right to direct the asset is indicated by the following: right to change the type of output produced, right to change when and where the output is produced. So if you have those, that means we are saying predominantly you have the right to direct the use. And then right, we're saying here the customer does not have the right to control the use of the identified asset if the supplier has a substantive, right, which is considerable right to substitute that asset. Okay, so before we go into 1.1, there is what they call a protective right, which does not affect the what? The assessment. Okay, it does not affect the assessment of whether you have the right to control, or let's say the supplier has the right to control the what? The asset. For instance, if I have an Uber company, right, and I give you my my Uber vehicles, then I restrict you. I say, please, after a certain number of hours, after a certain number of hours, please do not go to this area. Okay, so I'm saying here that I am protecting my asset from damage, theft, hijacking. So that's a protective right, for the supplier, but it does not mean that the supplier has a right of use to direct the use. He's just protecting his interest. You understand? So if in a scenario there is that clause that stated that the supplier is restricting this person maybe after 8 o'clock to say don't go to this area as an example, that means that's a protective right. Then you need to state that that protective right does not give the what? The right to direct use of the asset for the supplier or the owner of the asset. I hope that is clear. I hope that is clear. Then now we are saying that the right to control, right, is now addressed, okay, by means of what I'm going to explain, right, that an asset that is identified, right, between a customer and a supplier, right, will give the supplier a substantive right to substitute that asset. And when, I hope this is clear, when a supplier has a substitution right, the right to substitute an asset, okay, that he or she has given you, it simply means that therefore you as the customer do not have the right to control. And when you don't have the right to control an asset, that means it is not a lease. You understand? Okay, so that means, so that will nullify everything. Okay, that will neutralize or nullify everything. Okay, so that means you need to be wary of that fact if the supplier has a substitution powers, in other words, substitution powers over the customer. All right, so how do you identify that a supplier has substitution powers, right? This is found when it is stated that, okay, he has a practical ability to substitute with an alternative asset which is readily available and can be sourced within a reasonable time. So that means if I have given you one of my Uber cars, let's say I've given you the Mercedes-Benz, right, which is the black one, and then at any time I can take it away and give you a Toyota, or I can give you a Kia. That means I have the practical ability to change it at any time, right? While you are busy there in Santim, right, sourcing your customers, I call you and say, can you bring in that vehicle? I need to use it. So I can substitute. So as long as the supplier has a substitution right, that means, okay, in this case, with an alternative, substituting with an alternative asset that is readily available, those are the indicators that the supplier has a substitution what? Right, or substitution powers. All right, and then we've got the second point. The benefit of substituting the asset exceeds the costs associated with substituting the what? The asset. meaning to say that if the supplier stands to benefit when he substitutes, that means if I'm taking away the black Mercedes-Benz because I want to go and what? I want to go and use it to what? To carry more executive what? Customers. That will give me more money. In other words, that means I stand to benefit more when I substitute. That means the supplier has substitution powers. And if the supplier has substitution powers, that means the customer doesn't have substitution powers. And if the client or the customer does not have substitution powers, it means that you do not have control of the use of the asset that you are given. And then how do you then tell that if the supplier does not have substitution powers, right? One of them is can only substitute the asset after a particular date. All right. So that means as long as you are using it, as long as that date has not yet arrived, you have the power to direct the asset as the customer. All right. Okay. So here we're talking about supplier and customer. So we're saying you have the what? You have the powers. Okay. And then the second point is can only substitute the asset after the occurrence of a specified event. So that event might never take place. Okay, of which I said which might never take place. All right, so that event has to happen. Okay, for instance, if I'm still using the Uber example, I'm saying once you are not cashing in more than 5,000, I'm taking the car away. So that event might never come because you know how to source business as the customer. All right, the one that is what? That is leased or that is hired the vehicle for me. All right, so I'm referring to customer, I'm referring to the potential lessee. So I cannot really say lessee because that lessee-lessor relationship only comes about if a lease is satisfied. All right, the costs to substitute exceed the benefit to the supplier. So if these three are available, that means the supplier does not have the substitution powers. Okay. And then I said here, okay, the obligation for the supplier to substitute when the asset is not operating properly or when a technical update is required does not prevent the right of use for the customer. All right. So that means if the supplier needs to substitute because that thing is not operating properly or he's taking it away to fix it, all right, or to update it, that means it doesn't mean that he's got substitution powers. All right. So with this information, that is the theory that the examiner will require you to what? To include in your answering on this part, right to control the use. All right. So let's go to a question. This question is found on your self-assessment questions. Right. So it is question 2. Question 2. So this was required for 10 marks. It reads as follows. In a Word document, prepare an audit working paper for your audit manager to determine whether the agreement between TechMade Limited and Power Solutions Limited contains a lease. You see? Right, for 10 marks. Okay, for 10 marks. So it reads as follows. So I'm just going to read the part that says lease agreement because the other part has nothing to do with IFRS 16. Right. It reads as follows. On 1 April 2019, due to the frequent power outages, TechMade Limited entered into a contract with Power Solutions Limited to lease a 125 kilowatt generator from Power Solution Limited. So Power Solution is the supplier. Okay, I hope that's clear. TechMate is the customer. It took Power Solutions Limited 1 month to install the generator on the premises of TechMate Limited. The generator was brought into use on 1 April 2019. All right, so we're not going to talk much about this at the moment, but this involves taxation, right? The terms of the lease agreement are as follows. So we've got the fair value of the generator. We've got the biannual installments payable in arrears. So these are the payments. Okay, then there is the guaranteed residual value at the end of the lease. Then the unguaranteed, 20,000, the lease term, 4 years. The agreement further stipulates that the generator can be used for manufacturing other products. That is what the contract contains. The generator can only be substituted. Is saying only, so you need to read carefully, right? To a manufacturing fault during the warranty period. Any maintenance, insurance, and running costs will be the responsibility of Tech Limited. Tech Limited can also use the generator as and when it so wishes, and can also move the asset to other premises. You see, so these are the terms of the lease. So your question for 10 marks will be based on this information that I've just highlighted. Right, then it states Tech Limited will take ownership of the generator at the end of the lease term after payment of the guaranteed. After payment of the guaranteed what? Residual value. So you need to pay that amount. Right, Tech Limited paid legal fees of 15,000 and Power Solutions that much to Ndini attorneys for drawing up the contract. So this information will work when we're not doing the calculations, when we're now determining our rate implicit, which we'll then do in the following week. All right. So based on this information, I took the liberty to write out the solution, suggested solution. Okay, as this is taken from a UNISA self-assessment questions. All right. So based on this information, we are going to look at the solution on how you would obtain the 10 marks. Right, so it reads as follows. So as a student, you will then have to plan out your work, and it should make sense. So what I usually say to students is that put yourself in the shoes of someone that is explaining this information to a board, right? Okay, in a board meeting, right? People are gathered, they want to understand because they've just entered into a contract, but they're not sure what that contract is. So you need to explain to them in a way that will make them understand. Okay. So it says, a lease contract conveys the right to control the use of an identified asset, which I say the generator, because here we entered into a contract for the generator. When the customer, right, has bought the following. So the customer in this situation, remember, is TechMate Limited. Is TechMate Limited, right? So both the following. So remember, this is very important. The following should be present. You remember? Right. The right to obtain substantially all the economic benefits from the use of the generator as, so this is now me applying. Most students struggle with the application, all right? The application, how to apply. So you're applying from the scenario, right? TechMate has the exclusive use of the generator for the 4-year period. All right, it's got that, which is true. So you get a mark for that. Okay. No conditions on the contracts were mentioned to indicate any restrictions, which is true, because nothing else was given. If there was that information, we're going to pick it up. So you get a mark for identifying that. Okay. So this is all addressing the economic benefits, right, part. Okay. And remember, the economic benefit part is under the umbrella of right to control the use. All right. And then the second one under that umbrella is the right to direct. Okay. Is the right to direct. Right. The use of the identified asset, the generator. Then you apply as well. Application. So you need to learn how to apply so that you get the maximum marks. Checkmate makes the decision about what, when, and where the generator can be used due to the following reasons, right? The agreement stipulates that, so it is the agreement, as we all read there, the agreement stipulates that the generator can be used for manufacturing of other products. This guy allows you, he's not restricting you to the products that you're doing. So that means if you think of a business opportunity that might arise in the future, you can still use the generator for the other products, okay, which might maybe take more time to manufacture, but the contract allows you. So that is a way of telling you that you as the customer can direct, all right, the right of use. All right, so there is a mark for applying that. Techmate can use the generator as and when it so wishes. You are told all that is supporting the point of right of use. You get a mark for that. And can also move the asset to where? To other premises. You get a mark for that because all that was given in the scenario. Does it make sense? Okay. And then we've got the substitution that we're given in the scenario. They said power solution will substitute when there's a manufacturing fault. Okay. If it is, and which should be within the warranty period. But now that information was provided to test whether you understand substitution. I said power solution substitution rights, or powers if you want, are not substantive, okay, right, as the obligation to substitute when the generator is faulty, which does not prevent the right of use for Checkmate, because it's your obligation as the supplier, right, to fix it when it's faulty, right, or to replace it with another generator because I need to work. Okay, so we are saying that does not prevent Checkmate from having the right of use. That needs to be stated. Mark for that. Then you need to conclude if this person has the right to control the use, because number one is more important than the other three. So you conclude. When you conclude, based on the above, Checkmate has the right to control the use of the generator throughout this term. It's a mark. 1, 2, 3, 4, 5, 6, 7, 8. Right. And then you also state that Checkmate will use the generator for 4 years for the period of time, right? 8. Right. And then in exchange for the use of the generator, now you are stating the consideration. The generator, Checkmate will pay Power Solutions 6 equal payments of that much, which I showed you there, and a guaranteed residual value of 100,000 at the end of the 4 years. Okay, you get a mark. Then you conclude the contract between these and that is a lease as defined. And you're done. So you see how I'm applying and putting out the asset, okay, and the names and the figures. Okay, so that is how you would have what? Answered that 10-mark question. Okay. So thank you very much for tuning in. I'll be sending more videos on other topics, and if you have other requests, feel free to contact us on the email that is provided on our YouTube website, and we'll answer you as soon as possible. Thank you. Have a good day.